Good evening, ladies and gentlemen. I'm Andrew Packer, and welcome to Mr. Market's Mentor. Today's topic, Alan Greenspan is a hack. Yeah, I said it, and I'm not going to walk it back, because that's what the facts support. And here's why. Last week, the 91-year-old former Federal Reserve chairman stated that there was a bubble in the bond market, not in stocks. Now, I somewhat agree with that sentiment. After all, bond prices are incredibly high, yields are correspondingly low. They don't reflect unexpected market risks like sudden rise in inflation or things like that. So, while bonds will eventually look more attractive as interest rates tick up, right now that's moving slow as molasses, and there is definitely some risk there. But based on Alan Greenspan's track record, there's a long way to go. He's managed to make a career out of essentially failing upwards and being wrong far more often than he's right. He warned against high stock valuations in 1997, 2 years before the tech bubble blew up. He called it irrational exuberance. The markets were afraid for about a day or so, and then that was about it for 2 years till things ended up blowing up. And that's the essence of Greenspan. He's got a knack for being wrong, and he's got a knack for hiding that ignorance under the pretense of smart-sounding language. This is a Fed chairman who once stated, and I quote, "I know you think you understand what you thought I said, but I'm not sure you realize that what you heard is not what I meant." What insipid garbage. Naturally, the only people who would be stupid enough to eat this up would be Congress. Naturally, that quote comes from his congressional testimony. So, you shouldn't really believe anything anyone from the Fed says if they're going to be speaking such gobbledygook that's meaningless double talk. And frankly, the way the markets can move sometimes, your money can be at stake if a member of the Fed so much as blinks the wrong way. So, how did this accomplishment of Alan Greenspan becoming Fed chairman even take place in the first place? I'd say you have to go all the way back to 1958. Now, if you've ever taken a class in economic history, you know probably nothing about the 1958 recession. That's because nobody really talks about it. By definition, a recession is 2 quarters in a row of negative economic growth. And in 1958, starting late 1957, that's it. There were just 2 quarters in a row. Very, very narrow drop, mostly on the industrial and demand side, things like auto sales, and then it bounced right back up. It was seen as a little bit of weakness toward the end of the Eisenhower economy, but it wasn't anything that terrible, and most economists, didn't even really predict that. I mean, we all have periods in our life of 6 months where nothing seems to happen, and that's essentially what this recession was. Alan Greenspan predicted that, and out of that, I think, started growing this following that he was somehow incredibly knowledgeable about the economy when that might not have always been the case. So he was working his own economic consulting firm at the time. Going into the 1960s, a lot more people know about his background, being one of the followers of Ayn Rand, being a big believer in the gold standard, sort of the power of having a big check on the government in terms of having the money supply essentially independent, because that's what the gold standard is. The government really can't do too much to manipulate it, without getting into a lot of trouble and getting back into that gold standard era. But by the 1970s, Greenspan had weaseled himself into a position of chairman of economic advisors under Gerald Ford, and basically was playing the game. So in terms of an ideological consistency, there really isn't one throughout all of his career. And essentially, the rumor goes he was lobbying for the job of Fed chairman when he finally got it in 1987. Now today, the stock market, it looks pretty favorably on Greenspan, despite the tech bubble and the housing bubble, for a simple reason. In his first few months in office, there was the crash of '87, October 1987, one day, 22% decline in the market. The stock market exchanges have changed the rules since then. They've decided, hey, if there's anything that's going to look like it's even that severe, we'll just start slowing down trading. We'll close early if we have to. But a day after the crash, Greenspan came out and said the Fed stands ready to provide liquidity to anyone who needs it. And that was the start of the Greenspan put, and subsequently the Bernanke put, and at some point we'll probably see the Yellen put. At the end of the day, as Fed chairman, Greenspan came out there and essentially said, we're going to do what we need to do to keep the market stable, even if that means socializing the losses. The other issue with Greenspan's tenure came much later on. Right around the year 2000, the Y2K crisis seemed to be a problem. Greenspan seemed particularly worried about it, even though people knew about it years in advance and were making all sorts of changes necessary to get ahead of that. He kept interest rates pretty low, wanted to make sure the economy was going pretty much at full throttle just in case, make sure there was money around if people needed it. And then nothing really happened because people knew about the Y2K problem and it was a fixable, knowable event in the future, unlike some market issues where things suddenly seem to blow up spontaneously and people get caught off guard. The problem with that is after the Y2K bubble, Greenspan really wasn't in a rush to raise interest rates too much. It took a few years, and by that point the housing bubble was getting underway, lending standards were starting to come down. It was pretty much of a big mess. So Greenspan left the Fed on January 31st, 2006, leaving a ticking time bomb for his predecessor. Now, while he was Fed chairman, Greenspan really didn't spend a lot of time doing interviews, that sort of thing, but he did afterwards. One interview in 2007, he basically didn't see the housing bubble coming. He was talking about how it looked like the subprime mortgage issue, which really kicked things off, was contained. It wasn't going to become a bigger problem. Now that's actually really ironic, because as a doctoral student in 1977 at NYU, he wrote his thesis on soaring housing prices and their effect on consumer spending. So if anyone at all should have seen the housing bubble coming, it was him. And if anyone was in a position to prevent the housing bubble from forming, it was Greenspan. So I don't know where we'd be if we had a free market for money, if we didn't have the Federal Reserve in the first place, and we actually had a free market for interest rates, the cost of capital, rather than having this Soviet-style Politburo set it for us. But Greenspan set rates too low. And everybody got greedy during the housing crisis. Bankers got greedy. They could flip their loans to Wall Street. Wall Street could flip the bundles of loans to investors and pension funds, insurance companies. There was really no incentive to keep it on the books. But it all comes back to the fact that it was cheap. You could buy a house with little down, interest rates were low, and things just started accelerating from there. So, like a broken clock, Alan Greenspan's been right twice. Once by predicting the mildest recession in post-war history, and then again by extolling the virtues of the gold standard and curbing speculation. But that didn't really do anything to help, and it had nothing to do with his time at the Fed, and nearly 30 years of just being at the helm while things were setting up for bubble after bubble. So he's currently warning on the bond market, but if his track record is any indication, he's either going to be right a third time, or it's going to take him so long for him to be right that by the time it happens, people will have already moved on to a different and better investment idea. So as long as you're buying quality bonds and you're buying bonds below par value, and you're really making sure that you're not getting into the speculative high junk yield and really trying to reach for yield right now in the bond space, I think ultimately you'll be fine. But I wouldn't exactly go taking advice from somebody who was in the best intellectual position to see the housing bubble and completely botched it. So that's why Alan Greenspan is a hack. Thanks for joining us on Mr. Market's Mentor. I'm Andrew Packer. Till next time, stay safe and stay solvent.